Hi, I'm Pete Jones here with Peter Jones Realty. In this eye-opening episode, I'm joined by Matt Nolan, Senior Loan Consultant with New American Funding to explore mortgage myths that could be keeping you from your dream home. Think you need 20% for a down payment? Think again. Believe your credit score has to be flawless to qualify? We're debunking that too. So, Matt, welcome. If you don't mind, give us a little bit of background about who you are.
Fantastic. Well, thanks, Peter. Appreciate it. I don't know if this is coming through okay, but hopefully it is. But give you a little background on myself. I've always been in the lending space. I started off my career on the auto side of things. I worked for Chrysler Financial for a number of years, and so I've gone anywhere from reviewing financial statements from a dealership to consumer credit and everywhere in between. So I've always been actually when I started, we were just starting to use credit reports. So or credit scoring models. So I've been around for quite some time, as a gray hair kind of points out. But so I would say sometime in the 2008 2009 time period, when everybody was kind of running away from the mortgage space or whatever, I decided I'd jump into it. So I've been in it since then. Really love to help first time home buyers and all the way up to $1 million+ buyers to find the home that they're looking for and the best way to finance it for them.
So, Matt, speaking about that first time homebuyer audience, there's a myth that you need 20% down on a mortgage in order to qualify and in order to make it a financially savvy move for the person buying the home. Is that true? Do you have to have 20%? What are the other options out there?
Yeah, great question. Because I mean, yeah, obviously, the internet's great because it has all different types of information. But I don't think there's a litmus test on who could put information out on the World Wide Web there. So hopefully we can clear up a little bit of that. But so I work a lot with it's called IFA, which is Iowa Finance Authority, and I do a lot of their programs for first time home buyers. What the IFA program, again, it stands for Iowa Finance Authority. What it's really designed to get over that hurdle of the down payment. And so you asked the myth of 20% down. Yeah, we can do loans with 20% down. I don't do a ton of them with 20%. You can do it as little as 3% down or 5% down. But then IFA, what they did is they said, well, that's still a hindrance for home buyers getting into the market. So they've got programs out there that they'll give you up to 5% of down payment assistance. So even though the loan requires 3% or 5% down, the Iowa Finance Authority came in and said, you know what, we need to help these home buyers get into homes. A lot of people can afford a monthly payment, but trying to come up with a down payment is sometimes a hurdle. So what they'll do is with qualified credit, which it just has to be a 640 or better credit score in order to qualify. There are some income caps. If you make too much money, then you might be over those income caps. What they'll do is they'll basically give you up to 5% for a down payment. So let's just say, for example, a $200,000 house. They'll give you $10,000 to use towards down payment and closing cost, which will really get you over that hurdle to get into home ownership. Now, it's not a free gift. They do want their $10,000 back, but only when you go to refinance or sell that property. So I explain it to you this way, that the ideal scenario, where this is kind of the way the design of the program was meant for, is let's say you buy a house at $200,000. They'll give you the 5% down payment assistance. So that's $5,000 or that's $10,000. So you're financing, let's say $190,000. And let's say you pay on that for 5 years. Well, maybe that balance goes from 190 down to, let's say, 1. In that same time period, hopefully the house is appreciating in value. Maybe you're doing some updates to it, or maybe it just appreciates just because that's what home prices seem to do in the or past history. So let's say it goes from the value of 200,000 up to 225. When you go to sell that property in, let's say, 5 years from now, you owe 175, but it's worth 225. So they want that $10,000 to be paid back out of that net difference. It's a free loan, so there's no interest, no payments, no nothing on that $10,000. But it's a way to really get first-time homebuyers a jump start into the home buying experience. Then you can take whatever remaining value is left in that appreciation and use that on your next purchase. So that's kind of a perfect example of what the IFA program was designed for, and that's how I use it for a lot of people.
So, taking a tangent from that question, and I know private mortgage insurance (PMI) is a loan to value question, not necessarily a down payment question. But in that example, is it stand to reason that that person would still have PMI on on those payments for that initial period, or is that completely something different?
That's a great question. PMI, they call it all different types of, as you kind of point out, it's private mortgage insurance. They call it MI, mortgage insurance. There's a lot of different terminology behind it, but the essence behind it is anytime you don't have 20% down, you need to have some type of a mortgage insurance behind it. The bad part about it that's why a lot of people recommend you put 20% down. So that's when you can avoid that mortgage insurance. But this is where it really comes into play is your credit score. So your loan to value and your credit score are the two big factors that drive the mortgage insurance and how much it costs. So let's say you had a 650 credit score and you were looking for a 97% loan to value. Well, that mortgage insurance is going to be pretty high because it's at the highest loan to value you can get. And if your credit score is on the lower scale, that mortgage insurance is going to be pretty high. But let's say you take the same customer and they worked with their credit and they've got a 760 credit score, and they've got 5 or 10% down. The more you put down, the lower that mortgage insurance is. But for example, let's say on a $200,000 house, your mortgage insurance could vary by $100, $150 between those two examples. So if you've got good credit and you've got a little bit of money down, you really can save quite a bit of money on your mortgage insurance.
It's actually a great segue, Matt, to our next myth. The myth that you have to have a perfect credit score to get approved for financing for a mortgage. Go ahead and debunk that for me, Matt. I know I didn't ask a question, it's more of a statement, but it's not true, right?
No, it's definitely not true. I look for what's best for my client. So yeah, ideally, I'd like to have everybody have a 760 credit score, and I'm sure everybody would love to have a credit score of 760. But life happens. Let's face it. We got divorces, we got medical scenarios, we've got just I guess the phrase is young and dumb scenarios, right? I mean, life happens, and we just have to deal with it. The great thing about it is whether you do a conventional loan or an FHA loan, I would say if we're on the lower end of the spectrum on the credit scoring model, we'd probably be looking at FHA, which is a fully backed government loan. Those programs, the funny thing about it is there's no minimum credit score that says if your credit score is this, FHA will not allow it. Now, some banks have overlays and they won't allow you to have a crazy low credit score. And sometimes it's not necessarily what the credit score is, but basically what's out there. So let's say you had a 570, a 580, 590 credit score. Anything in the fives, yeah, it's not a great credit score. I'm not going to lie to somebody, but there's nothing that says that FHA will not allow you to have a credit score, but some banks might have overlays on that. I would prefer to help somebody. There's a lot of little tricks that we can do to get somebody's credit score up. So whether we're ready right now, today, to go look at a house, or maybe we need to do a couple things. We did tweak a couple things in the credit report, and maybe in 30, 60, or 90 days, we can get it from that 580, 560, whatever, to over 600. I prefer to spend a little bit more time on somebody's credit to get them to that next threshold, to get them an overall better deal at the end of the day. The myth of you need to have a 700-800 credit score to finance something, that's simply not true. But obviously, the higher your credit score, the better the quote unquote deal will be, meaning interest rate, less down payment, et cetera, et cetera.
Sure, makes sense. All right, myth number 3: pre-qualification is the same as pre-approval. Speak to that,
I
Matt.
think
Is that
no, it's not. So I think they get interchangeably used quite a bit, and I will tell you that there is a difference between using a local lender and probably an internet type based lender. I'm not picking on any particular bank that's out there, but there's plenty of banks out there that you could fill out an application online, and you could say you work at McDonald's and make $200,000 a year, and so they're going to take that as true, right? They don't really care if that's valid information or not. They're just basically going to get you a pre-qualification. So pre-qualification is basically when a customer says, this is what my information is, and the lender goes with it. A pre-approval is when I actually look at documentation and I say, okay, well, you said you make $200,000 a year working at McDonald's, which is fantastic. I hope that's the case. But if that doesn't come out to be the truth, and I look at the bank statements, or I'm sorry, the pay stubs, and your actual income is maybe it's $15 an hour, or $17 or $20 or $25 an hour, then we're going to make that adjustment and get the pre-approval adjusted to what's going to fit your budget and your income. So I would say a pre-approval is where the lender verifies that you've got the income you think you do, the assets you think you have. And a pre-qualification is, again, saying I work at McDonald's and make $200,000 a year. So I'm not saying that there's not somebody that owns a McDonald's out there that may not make $200,000 a year, but probably for your typical person that works at McDonald's, that's probably not in the realm of the income bracket.
For sure. Yeah. So pre-approval is more verified than pre-qualification. Is that a good summary?
That's a good summary. You took my 5 minute spiel there and condensed it down to 2 seconds. So yes, that's a very good assessment.
All right. Well, no, it's only four minutes and 30 seconds. It wasn't 5 minutes. Okay.
But who's counting?
So
Who's counting?
myth number 4, and I think this plays a lot into today's interest rate scenario. Everyone's saying interest rate. So the myth is that the lower interest rate is always the better deal. Could you speak to that, Matt? Sometimes it's true, sometimes it's not. I know it's varies by case, I assume.
Yeah. So I would say getting with a experienced loan officer is probably the best way to do it. To your point, yes, on the surface, you'd think that, let's say, if I can get you a 5% interest rate, that'd be a great deal versus, let's say, a 6.5% interest rate. So, yes, anybody out there would say, yes, 5% is better than 6.5. But what if I said, in order to get to that 5%, it's going to cost you points, and points is where it's a one-time fee up front where you buy. It's called buying points down. Let's say it's going to cost you, I don't know, 6 points or 5 points to get you down to the 5% range or whatever. So if you've got a one-time cost of, let's say, $15,000 to get that rate from 6.5% down to 5.5%, is that still a good deal? Well, on the surface, yes, the interest rate's lower, but it costs you all that money in points to get that down to that rate. What I like to do, and especially in this environment, nobody really knows what rates are going to do in the future, but I think most experts are predicting and are hoping that we're in a decreasing rate environment. So if we're in a quote unquote decreasing rate environment and we hold that to be true, then buying points right now is probably not a good idea, because let's say you bought it down to 5.5%, but at the end of this year or beginning of next year or whatever, rates go down to 5%. Well, if you don't hold that mortgage long enough to recoup that investment you had, then you kind of wasted some money in it. So I kind of blow it out of proportion when I talk about the big spread in interest rates there. But I would say that the devil's in the details. So just because somebody advertised they've got a crazy low interest rate doesn't mean it's always the best quote unquote deal out there. And I think that was the essence of your question.
Yeah, for sure. So myth number 5, you guys, mortgage lenders, you only care about the income. Nothing else matters. What do you think about that, Matt? Is that true? Obviously, you look at more than just income, but there's a myth out there that all you care about is how much cash they have coming in.
Yes, that there's a component to it. It's the debt to income ratio. And so back a ways back, they passed the ATR rule. So it's called the ability to repay. The abbreviation is ATR. So you do have to make sure that a client does have the ability to repay that mortgage. So yes, there needs to be an income component to it, but obviously credit scores out there, longevity at the jobs out there. So there are a lot of different components to it. And I think the big thing I get into is when somebody's on Social Security or a disability or something like that, where you got you may not have a W-2 job or a typical 9-to-5 job, but you do have a steady source of income. Yeah, there's formulas we use all the time for whether it's Social Security income or disability income, and those can all be used as income. But we do need to verify that anybody we're making a loan to has got an income source that's going to sustain the payment. And I think back in back in 08 time period or prior to 08, you had banks that were making loans to people. Let's say they put $100,000 down or $200,000 down. So you had a big cash commitment into it, and they didn't really care about the income piece. Well, what they're finding is even though somebody had a big amount of money down, they couldn't afford the monthly payment. And so then there was a lot of lawsuits going on where the bank had security in the property, but the customer didn't have the ability to repay it. And that's where these laws came into play. So maybe they got $200,000 invested into it. Well, the bank took it back because they couldn't make the monthly payment. And then that was deemed to be a predatory lender. So I do get that piece of it. Nobody wants to get somebody in over their head on a payment. So even though, yes, the income is a big component of what we do, it definitely is not the only component, but that's kind of a little history and why it's a big piece of it.
And this last one, you and I have worked on with a couple uh, customers that have come through recently, and I think it's pretty prevalent in the environment we're in today, because people are trying to buy new homes while also potentially figuring out how to sell their homes and balance that dichotomy of having to buy and sell in the chaos. A lot of people assume, or the myth is, I have to go ahead and put an offer on the home I want to buy with contingent upon selling my other home because there's really no other option. And I know from conversations you and I have had, that's actually not true, and there are many other options. Do you mind elaborating what those are?
I mean, and I will tell you, that's why I think I'm not saying I'm not picking on anybody that doesn't have gray hair, but when you look at somebody that's been seasoned in the industry, you kind of know all the I won't say ins and outs, but all the different scenarios that potentially could come up. One of the things I do a lot, let's face it, if you're selling a house and you're trying to buy a house, depends on who that customer is and what their level of stress level is, I guess. It's a lot of there's a lot of work that goes into it. So trying to sell a house and close on a new house the same day, it happens every single day. But does it happen without stress? No, there's a lot of stress involved in it. So I mean,
Absolutely
there's
not.
scenarios. Yeah, I mean, so what I would say is I look at all different options for somebody to do. So we could look at doing a bridge loan, which is basically like a home equity line of credit on the current house to pull some money out of that to use for the down payment of the new one. Also, the one I use a lot of is if somebody's got at least 3 or 5% to put down on the new purchase. Typically, it's 5% down on the new purchase. But if they've got 5% to put down, we would just close on it as long as their debt to income ratio would qualify. We would close on it with them putting 5% down. And let's say then, a month later, 2 months later, 3 months later, they sell their other house. Then let's say they've got $300,000 worth of equity on that property. They could do something that's called a recast. And so what they would do is, so let's say the new loan was $500,000 and they want to take $300,000 from the house that they just sold and apply it to the new one. What we would do is we would wait till the other one sells. They got this $300,000. They would do a recast on the new mortgage, send the $300,000 in, and then behind the scenes, we would recast that loan as if they would have had that $300,000 down. So that would lower their payment down on the new mortgage to as if they had the $300,000 down. So I would say there's just a lot of different ways you could do it as long as the debt to income ratio can work where you qualify having both those payments out there. I do that a lot because it does relieve a lot of stress and a lot of anxiety that people have going from one to having both houses to one house or how you're going to get those dates to match up.
Yeah, for sure. There's no way to avoid stress in that scenario. However, speaking to a gray hair or somebody who's been in the business for a little bit is a good way to go about it because there are options. You don't need to have everything fall in line for it to work. There are options. And I've even heard things as far as like doing lease backs on the current home where you sell it, everything closes, but you agree to a 30, 60, 90-day window with the new buyer that you're going to stay there, potentially figure out some sort of payment for those 30, 60, 90 days and go down that route too. So at the end of the day, there are options for you if you're in that scenario of trying to buy and sell at the same time. And also, we've certainly debunked several myths with regard to mortgage lending, which was obviously the goal. The more I get in this business and the more I understand your world, these myths are funny to me because it comes from a perspective of just not having enough information. And hopefully today we've helped share that information and educate and bring people to a clearer picture with regard to mortgage lending. So with that, Matt, thank you for your time. I appreciate it.
I greatly appreciate the time, Pete.